Good evening, Ivan. You can see your screen.
All right, so let me first go through this question chap. Since Florence was interested in it, and then we move on to IFRS 16. Let me hope we are all practicing because time has really moved so fast. You are soon sitting for your paper, and so we are in the last days of the preparations. Make sure that at least each day you try out a question and you debrief it. I shared with you the super 20 questions that you must attempt. Please go through them. They are in the examination kit. The answers are there. So you practice under standard time as we agreed. Then later on in the evening you can debrief and see where you went wrong. Alright, so let us discuss this. A few minutes I know will be enough, and then we proceed. Prepare a briefing note for the directors of Jumaco which answers their queries relating to the SAR. Alright, so they just want us to read through and see which queries are there, and then you write your answer. These formats don't mind so much about them because they are not important in your paper, so long as you adopt the headings, the short headings, underline, and then you give your answer structure, you'll be good to go. Alright, so what are these queries that are in the scenario regarding these SARs? Okay, John has an equity instrument in an entity called Jumaco. The directors of Jumaco are inexperienced and would like to confirm how some share appreciation rights should have been accounted for. Of course, we said once you see share appreciation rights, this is an example of a cash-based payment. And so you have now to move to that treatment of cash-based payments under IFRS 2. The details are as follows. On 1st October 2x5, Jumaco granted 500, this is very important, 500 share appreciation rights to its 300 managers. So you have 500 and 300. Okay, the date is also important to know the period or the time of the option. All of the rights vested on 30th September 2x7. So they're telling us that on 30th September 2x7, okay, all of them vested, meaning that at that point anyone who held these rights had the opportunity to exercise them, but they can be exercised from first. Okay, they are putting up a condition. Yes, they vested on 30th September, however they can be exercised from 1st October 2x7 up to 30th September 2x9. So here the trick was, what was the vesting period? What was the vesting period of the shares? Who can tell us what is the vesting period of these shares? Anyone?
Like in number of years or
Yeah, of course, when I say vesting period, I mean number of years.
2 years.
2 years. Perfect. Perfect. So since you saw that from 1st October to 30th September 2027, those are 2 years. These other ones was just the period that these guys were given for them to exercise their what? their options, meaning that after that period, after 30th September 2009, you cannot exercise the options. At the grant date, which is the 1st October, the value of each SAR was 10, very important. And it was estimated that 5% of the managers would leave during the vesting period. So this question, I think, answers a query that Raymond raised when I was discussing IFRS 2 regarding how you determine the expenses for the year going forward. And I talked about subtracting. Okay. Estimated that 5% of the managers would leave. So how many managers are going to enjoy the shares as at the grant date? Who can tell us? $100 minus 5%, not so? Okay. At 30th September 2006, the estimate of how many managers would leave during the vesting period remained at 5%. So nothing really changed from that point in what? From that point in time. And remember, no one has left. So we are going to use the 5% throughout. The fair value of the SARs was as follows. And we said that for cash-based payments, we must consider the fair value at each reporting date. Meaning that the fair value at grant date is not relevant. What is important is the fair value at each reporting date. And this is different from the equity-based payments, if you can remember. So, all right, so this is enough information. We have the reporting date, fair value. We have the number of shares. We have the managers. We have the remaining employees at the end of the vesting period. All of the managers who were expected to leave employment did leave the company as expected before 30th September 2007, meaning that it is true the 5% went on to leave at the vesting date. On 30th September 2008, now here they are talking about when you can vest here. That is the period. On 30th September 2008, 60 managers exercised their options when the intrinsic value of the rights was 10.50. Amazing. And were paid in cash. So at 30th September 2008, 60 guys enjoyed their money. And of course, the cash that is paid should be paid as per the intrinsic value, if you remember very well. So we are going to pay out on this date. We shall pay out 60 managers at a value of 10.5. Okay. All right. And we are paid in cash. The directors of Jumaco would like to confirm how the SARs should have been accounted for from the grant date, this, and whether IFRS 13 fair value measurement or IFRS 2 share-based payment applies. Now this statement here takes us to a question that Patience asked me, not was Florence, when I was discussing IFRS 2 from the website, where they mentioned which standards do not apply for which standards or which situations IFRS 13 does not apply. Okay. All right. So we should know that there are certain standards where IFRS 13 does not apply, because for it only applies where a standard allows fair value measurement. Are we getting it? It allows any standard that allows fair value measurement, IFRS 13 applies. Though we are talking about fair value under IFRS 2, this IFRS 13 does not apply. Okay, so with this comment here, you just say that IFRS 13 is excluded with transactions that regards share-based payments. Because IFRS 2 says we can obtain the fair value of the liability using option pricing models. If you've gone through very well your notes and you summarized, you know that we use option pricing models like the Black-Scholes option pricing model to find the fair value of options under IFRS 2. So IFRS 13 does not apply. I hope you are all okay with that. Alright, so now this one I've answered. Let me show you the calculation. I don't know where Florence got stuck from, but I can work out the calculation and show you what I really wanted. Okay. So meaning that, what was it saying? And whether, okay, here you just say they would have used IFRS 2, share-based payment, and then you talk about this being a cash-based payment. We consider the fair value at each reporting date. Okay, so here we have the year. Then we can have our expense for the year. Raymond, you can pay attention here. And then what is the liability? This expense goes to statement of profit or loss. This liability is recognized in the statement of financial position. So for the first year ended 30th September 2006, 30th September 2006. Of course, for year one, okay, for year one, the liability for that year becomes the expense. And this is very easy. How do we get the liability for the year? You get how many managers were given, 300, times 95%, because we expect 5 to leave, times this 500, then times the 9. I'm sure we all did that. This is going to be the 300 times 95% times the 500 times the fair value at reporting date, which is 9, and then we said that we have to apportion this liability according to the vesting what period. And how do we apportion this? So which fraction am I going to use? Anyone to tell me? Which fraction? A half. Because we said the vesting period is 2 years. Alright, so what do you get here? Florence, you said you calculated. What did you get here? Florence, are you here? Florence, are you here? Okay. What are you getting here, guys? Are you getting 641?
641, 250.
Perfect. And we said that this for the liability for the first year is what goes exactly to profit or loss. So this is 641, 250. And in your exam, if this question comes, you have the opportunity to use Excel, because this is a complicated calculation. Don't put it in word processor. Just go to Excel, create those 3 columns, and then you work out. I'm going to show you how we can move our answer from Excel to Word. I'll show you. This working, we put it in Excel. In fact, those who have watched my lectures, we call this working note 1. SA SAS calculation. That's what you put in your Excel. You can even bold it. You go ahead and work out. The second year is 3rd September 2x7. Remember, no one left, and they said that we are maintaining the same what? The same percentage. This one here. So we are maintaining the same percentage even in the next coming year. So we have to start with the liability, with what goes in the statement of financial position. Then how we get what goes to statement of profit or loss, we just subtract. Now, since the same percentage is remaining, I'm going to copy this. You're getting it? No one left. So we take the 300 times the 95 times the 500 times, now at the reporting date, the fair value is 11. So I'm going to use that here. 11. And now here the fraction. This is a 2-year arrangement. So this is 1. And what do you get, Raymond?
It's 1,567,500.
You said 1,656.
1,567.
156.
Okay, like that, eh?
Yes.
Okay, now my question is, remember why we used all of this? It's like we are estimating the liability without considering the conditions that happened in the previous year. So, meaning that at 30th September 2027, this is the liability. But in our financials, we already took this liability and this expense. So meaning that this liability has increased from this to that. So that increment in the liability is what we take to statement of profit or loss. And what do you get?
$250. 926,250.
Okay. So I told you, by the way, SBR is not so much number crunching. But if you're unlucky and you get this question, then it is okay. Because we assume that you did this in your FR paper. So number crunching might not be so much in your what? In your paper. So this is where we are. But these guys are telling us that. Yes, any question? Okay. Someone just having issues with the network.
Ivan.
Yes, please.
So when we are writing these entries in the financials, that means we're going to write as at 30th September 20x7, we're going to write 1.567,500, not 1.56 plus the 641, right?
No.
We are writing the 1.567,500.
Yes, that is the liability at the end of that year.
Yeah. Then the expense is at the end of the year. Do we use the total of 20x6 and 20x7? Okay, I'm asking.
That what do
when
we
it
do?
comes to expense. Expense.
Mm,
Because now, let me say you've credited 1.5.
mm.
But where for every debit there is a credit, right? So I'm assuming that for expenses, it will be a total of the 600 and the 900 to make the 1.5.
You see, during the year, you are debiting
Mm.
926, crediting 926. Are you getting it?
Okay,
I think you've lost network.
I thought you credit the 1.5.
Please,
That's what.
please. In the year, you see already in your statement of financial position, there is
Mm.
641,250. Are you
Yes,
getting it?
yes, yes.
These are simple basics. In 2x8, in 2x6, we debited P and L. How much was it? 641,250. We credited the liability. This is a cash based, right? Liability 641,250. You get it?
Mm.
Now in 2x7, you are debiting 926, okay, 250, and you credit,
Yeah.
okay, you're debiting P and L. That is the expense for the year. Okay,
Yes. Mm.
that is what the managers have given you in terms of service. Okay,
Mm. Mm.
926, 250, not so. So this
Yes.
credit here is driving the value in the SOP to 1567.
Okay.
Because this is more like an addition. You get?
Yes, yes.
So it is increasing the value in your SOP to this. But for the liability for the year is this.
Okay, okay.
Now you've got it?
Yes. Thank you.
All right. So guys, we proceed. Okay. Remember, by the end of at the vesting date, okay, what is 300? Okay, input here, employees remaining as at vesting date. It is 300 times 95%, because they told us that all of the managers who were expected to leave employment did leave. So the 5% left. So by the time the options were vesting, the 5% had left. So how many are remaining?
285.
200? 280?
85.
So, okay. So at 30th September 2x8, where is it? On this date, these guys were paid. Okay. Now let us now calculate, because they said these guys are given 2 years for the options to lapse. So after 1 year, 60 exercise their options. So we should get this. So after a year, how many are still demanding the company? How many are still demanding the company? Remember, you had 285, not so, but you paid off 60. You paid off 60. So these guys, the balance of 285,
225.
225.
yes, the balance of 225, they are still demanding you. Now you go back to the same calculation. 225 times, we gave them 500 each, times the fair value at the reporting date 12. So what do you get? What do you get here, guys?
1.350. 1350.
1350.
Zero. Then you put together 000.
Okay, perfect. Now the question is, what is the expense for the year? Yes? What is the expense for the year? The one that is remaining now.
423750. 3750.
How are you getting it? Because see, here we got 1567, not so? And then here it has reduced by this much. Are you getting it? So what is the net decrease in liability? That was now the trick. The net decrease in the liability of dollar. This is one. Since I've used the word decrease, let me use 1567500
So,
minus
yes,
So it's a negative.
it is a negative.
Ivan,
Yes, please.
217.
97,500.
What is it?
97,500.
Okay, can I take the students into that? Okay. The net decrease in the liability of dollar. What are you getting, Florence?
217,500.
217,500. Okay. But remember, this is a decrease. Okay. But you've already paid up already. You've paid cash out of dollar. We are paying 60 guys, right?
60 days.
We are paying 60 guys. Each of them was given 500, and then we are using the intrinsic value. We say that we use the intrinsic value when we are cashing out. So the intrinsic value is 10.50. So we are going to have 10.5 what? 0.50. And what do you get? The 60 times 500.
315.
You get 3?
15.
You get 315. You get
315.
315. Okay. Now what is you see we paid out this. Alright? And there was a decrease in the liability by this much. Meaning that the expense for the year is the difference between what we paid out and the decline in the liability during that year. And if you're getting it. So the expense for the year is the dollar 315 that we paid out minus the decline in the liability. Because we paid out these guys, there was a decline in the liability of what? Of dollar 217,500. So this gives us what? Do you get 97? Just like what Mike was telling us.
97,500.
97,500. So this one here was the expense for the year. such that if you get this, okay, this 1,567,500, you remove what you paid out, okay, this, to get what this now is giving as now the running liability that should appear in your financial position. I don't know if you're getting the argument. Guys, are you getting it? Alternatively, what you can do, okay? What you can do alternatively, you obtain what you paid out. Remember, alternatively, liability as at 30th September 2x7 was $1,567,500. Then you less amount paid out of the 60 guys. Let me not even use equals. Let me do this. So we paid out how much? We paid out $315. Okay. So now this gives us the estimated carrying amount of the liability, which is $1,252,500 1,567,500 minus 315,123. It's 1,567,500 minus 315,123. This gives you 1,525,500. Not so? Okay. Now they are telling us that the liability as at 30th September 2x8 is dollar this, because we calculated it. You getting it? It's $1,135,0,123, meaning that the liability during the year, the liability has increased by the difference between the two. Liability for the year, which is year 2x what? 2x8 is going to be the difference, which is the same as 97. Not so?
Yes.
Is the same as 97,500. So this is also another alternative that you can use. So this is our balancing figure. So are the two alternatives okay with everyone? I mean the two options. You can either use this, which is very few steps, you have the expense for the year, or you go in the long way. You use that. It will still give you the answer. So Florence, have I answered your query that you had?
Yes, you have.
All right. So I think Michael had got that trick, because he gave me this figure even before I showed you how we can derive it. Now I want to show you how you can move, okay, assuming that you have what? Because the question was, we are accounting for which year? For 2x8, not so? Because that is the year they're talking about. The directors of Jumaco would like to confirm how the SARS should have been accounted for from the grant date to 2x8. So what you're going to do, since you have two tables, you call this working note 1 SARS calculation for 2x7, 2x6 to 2x7. Then here you say, here you can say, you can either take this or this, right? So someone who has used the table in Excel to get the expense for the year, you say working note 2 2x8 expense calculation. Okay, so now this is going to be in your Excel. That is going to be in your Excel. So now let me take this. Someone who didn't go with Excel, let me just do this. So someone is going to say, now in word processor, in word processor. So you're going to say that, please refer, maybe if this is question 2, part B, number 1, because you should have this in your answers. Okay, so you say, it's question 2. Then you say that, please refer to Excel. In fact, we call it a spreadsheet, not Excel. Please refer to spreadsheet for calculation of, okay, please refer to working note 1 in spreadsheet for calculation of SAR's account treatment for the years 30th September 2x6 and 2x what? 2x7. Then you say that, you come and write. Remember I told you this paper is more of writing than number crunching. You putting this like that will not earn you all the marks. So you say that, okay, do we have the name of the company? Okay, you say that John has an ent, okay, Jumaco, so can say, what is it saying? Okay, so you say that the directors of Jumaco, remember, guys, remember, we are not forgetting our state. Okay, so you will have your state. You write anything about IFRS 2 as per the what? Per the scenario. Then this is more like your application, which is apply. Okay, please refer. Then your conclusion. You see how you can systematically write these things. Then your conclusion, you say that the directors of Jumaco should recognize dollar, you can pick that value, 641250, dollar 641250 as an expense in the statement of profit, or loss, and dollar 641250 as a liability in statement of financial position for the year ended 30th September 2x6. Then you say in 2x7 7, okay, dollar, so you take this, okay, 2x7, or course you say dollar should be recognized in the statement of profit or loss, okay, as a liability, as an expense, increasing the liability in statement of financial position to dollar. Then you pick this figure here, you pick that figure, then you put it. I think I even removed, okay, it's okay, I'll retype it. So you to dollar this, okay. Then since you have another working note, okay, since you have another working note, I'm just showing you how you would have presented your work if the question wanted you to account for the 3 years. Remember, in this question, they only wanted us to account for this year. But my approach is showing you what they want you to answer for the 3 years. Then I'm going to show you how you just go direct for, if it was now like the way this one is, we just now write this what I'm going to write now. You just say, okay, we just say that refer to working note 2 for calculation of expense recognized in 30th September. I'll change this, September 2x8. Refer to working note 2 for calculation of the expense recognized for the year ended, 2x what? 2x September 2x8. Please refer to working note 2 in spreadsheet for the calculation of this. Then you say that the directors of Jumaco should recognize dollar 97, is it 500? 97,500 in the statement of profit or loss as an expense and a liability of dollar. What is our liability? This one here, 1350. Liability of dollar 1350 in the statement of financial position. So if they had asked to present to write an accounting treatment for the 3 years, you do that, okay. But since this one was for 2x8, you do these calculations. Let me show you. Okay. Okay, so you do this. How can I separate the two? How should I separate? Okay, let me just show you. Let me just say that for the question above, in word processor, you say that please refer to working notes 1 and 2 in the spreadsheet for the accounting, for the calculation, for the calculations of the SAs. Then you come and copy this, copy that, come and put it here. I don't know if you're getting my argument. Guys, are you getting my argument? Hello, are you getting my argument?
Yes.
All right. So the first one I removed it, but we said it was like this: amount paid. Let me even call it working note 2, the one that is having alternative 20 2x8 expense calculation. We said change in liability, it was dollar, is it $217,500. Amount paid out, it is dollar 315. Of course, here this one now you have to work out. You say 60 times 500 times 10.5, which is the intrinsic value, the one that we use when we are cashing out. Okay, so we now have expense for the year, dollar, that is the difference. The difference is 97,500. Then you can take it here. So someone can either use this or can use the alternative. And under the same situation, you just use only this brief in your word processor. Just refer the guys to the working notes in the spreadsheet, and then give the conclusion of the question. So is that okay with everyone? And we proceed. Guys, is that okay? And we proceed.
Yes.
Okay. Raymond and Joseph, are we okay?
Yes, sir. Yes, we're okay.
Especially this trick here of moving from Excel to Word. It's very important. All right. Let us now look at IFRS 16, a brief one. Then we'll do a question. I'll be very fast. IFRS 16. And this one is what? Leases. Meanwhile, guys, IFRS 2 and IFRS 16, they are very critical standards, just like the financial instruments. Very important financial instruments, IFRS 9, and then group accounts. So you should be able to get used to the questions that come from these standards. I think in December All of those standards came. Group accounts, IFRS 9, IFRS 16, IFRS 2, they were all there. So when it comes to leases, let me ask you, should I just give you a question, or you want me to revise something with this standard?
Revise something.
Raymond. Yes, Joseph.
Yes, we can revise, especially the sell lease back.
Sell and lease back.
Yeah.
Okay.
Revise.
Revise if I were just being lazy. And me to go through again the same stuff. Okay. So when it comes to
Okay.
uh-huh.
Okay, from that part of lesser accounting.
This account.
Yeah.
Okay, let me just go through them chap, yeah. One, what is very important is for you to know the conditions under which a lease exists. And of course, that is the definition. If you know the definition very well, then you can know in the scenario, they will give you something that shows that, okay, all these conditions are leading to a transaction that qualifies to be a lease. Is that okay? So you should always, I remember in my paper leases, this standard came and it wasn't so direct. They will give you just some situations. So it is up to you to assess and see, to either treat it as PPE, intangible asset, or a lease. And what do we always look out for? Okay, we always look out for something like a contract. A contract. Is someone putting up their hand?
Yes, just a short one. I saw something like where they talked about leasing, then they talked about investment property. A lease is also part of investment property, because I feel like leasing we also whatever renting out. Are they part?
Not really. Please.
They're not.
That's why I'm saying you must know these things I'm putting down here. A lease and investment property are totally different things. I'm going to give you an example. The question you're going to calculate, let me get one that has where a director confused the two. Are you getting it?
Yes, I'm getting it.
Yes. IS 40 and IS 16 are purely different. And how do you differentiate them? Knowing the definition of investment property, rental income, capital appreciation, and known use. For leases, there has to be a contract. Okay? That can be either a full contract or part of the contract. And that contract gives a right of use. A right of use of the asset into consideration. Okay? That asset can be a building, it can be a machine. Are we getting it? So always look out for a contract. And so you must be knowing what a contract is. Two parties agreeing. And there is always a consideration. That is the definition of a contract according to your corporate law. So there should be a contract that gives a right to use of asset for a given what? For a given period. And someone gives out some money. There has to be a consideration. This consideration can be money, or you can be leasing out an asset in exchange for another asset. So depending on what you have agreed to be the mode of exchange, so long as you get a right to use that asset, then that gives you what we call a lease. Are we getting it? And the standard says once, now this is the side of the lessee, once the lessee has a right of use asset, they have also to be having a liability, because you are going to be using someone's asset and in turn you should be paying them. So you owe them something in form of what we call a lease liability. Are we getting it? And once you have a right of use asset, then the definition of an asset comes in as per the conceptual framework. Okay, you only have a right to use that asset if you control that asset. And you can control an asset if all the economic benefits of that asset, you are to enjoy them. And two, if you can direct the use of that asset. So if you watch the standard, if you watch the conceptual framework, you should be able to remember these terms of an asset. You must have control over it. Okay? And having control over it comes from enjoying the economic benefits of that asset and also being able to direct the use of that asset. So those are the key things that you must look out for when it comes to a lease. Do you have control? Entity has control over the asset. And how do we know that there is control? Entity enjoys all the economic benefits arising from the use of the asset. And also entity has the right to direct the use of the asset. Guys, with your paper, more of writing is important, because the calculations is what we call the own figure rule. You can get the calculation wrong, but once you have applied the knowledge of the standard, you get the what? You get the marks. So once you know this, and then you know what we call the lessee and the lessor, then you are done with IFRS 16. Because now what is next is looking at the lessee accounting. That is, if you have C gives a right of use of the asset for a given period to the lessee, the person who is going to use the asset, there has to be consideration to who? To the lessor. So you should know the accounting treatment for the lessee and the accounting treatment for the lessor. So when it comes to the accounting treatment of the lessee, we said that the standard wants you to use the lessee must recognize a right of use asset and then a lease liability. Right of use asset and then the lease liability. This right of use asset, because you're recognizing an asset, you've not bought it, but you have the right to use it because you control it. And in turn, you recognize a lease what? Liability, which is going to represent the money you're going to be paying out to the lessor. Let me hope we are all following. Now, when it comes to the lease liability, here we said, for the lease liability, we consider the present value of the lease payments. Present value of the lease payments that are outstanding. Guys, are you following me? And how you should understand the concepts? Let's see accounting, two concepts. Right of use asset, lease liability. Lease liability, since you're going to pay it for a given period of time, you have to find the present value of that future payment. That's why we are saying that you get the present value of the lease payments that are outstanding. And these payments that are outstanding can be in form of any fixed payments, that is if you're going to be paying every month or annually 2 million for 10 years. That gives it the fixed payments you're going to be paying to the lessor. Or they can give you conditions that you'll be paying variable payments to us. They can be fixed or variable. And these variable payments can be tied to the performance of the asset. That the more units you generate from the asset, maybe for each 100 units you generate from using the machine, you give us 2% of the revenue generated. That becomes a variable payment. The services also can also include what? Any amount that we are likely to pay you as residual value guarantees. That for, you know what, my asset, by the time you return it, it should be worth this money. So if it is not worth that money, you have to pay me this much. So what residual value guarantee payments. Here you are telling someone that, you know what, I'm going to look after your asset very well, so that when I return it, it should be worth that much. And again, also termination penalties. So if you think you might not use the asset for the entire period of the lease, then they will tell you that, you know what, you're going to pay me a penalty for terminating our agreement. Remember, this is a contract. So if one party breaches the contract, a penalty has to be paid. So in case in your contract you have termination penalties, also the present value of those termination penalties must be included. I was discussing a question for you guys regarding this. Who can remember? Do you remember that question? Last time we discussed?
About the termination.
Yes, do you remember it?
Yeah, the termination penalty.
Let me try to get and then I show you guys, because it is very important that we get the concepts. Which question was it? Let me check if I can see it, because they will pick something small from a standard and then they put it in the scenario. So if you've not practiced enough to see many things, many ways of setting the question, then you will not be able to answer. But let me get you that question where we had to talk about the termination penalties in one of our explanations. It is here. I've got it here. It is the question that we discussed last time. It had this statement, just a single line in the case scenario. It was like that. So I can say e.g. included within the future trading losses is an early termination penalty of 6 million for a leased asset which is deemed surplus to requirements. Are we getting it? So we are saying that for any termination penalties, we must get the present value. Yes, Raymond?
You said I was going to ask whether you're supposed to discount the 6 million to the present value, but you have answered it. Thank you.
Yes, that's what you're supposed to write in your answer. That as per IFRS 16, the present value of the termination penalty should be obtained. Is that okay with everyone? And it's good that we've seen how questions can be set. All right. So guys, this is how we account for the lease liability. You include anything that is within those items that we have discussed. And please try to understand the key concepts of the standard. The examiner will pick something very small from the standard and they want you to write about it. So, yes, please.
Now, like this example that you highlighted, the penalty, there's no any discount rate. What would you use to get the present value of it? What rate would you use to discount it?
As I told you, Joseph, that this paper is less of calculations, okay, and more of what? And more of discussions. You get it? So, what the examiner wanted you to say, you get it, was that as per IFRS 16, the lease liability should contain termination penalties, not so?
Yes, yes.
As such, the lease liability should be remeasured with the present value of the termination penalty included. Are you getting it?
Yes.
So they will give you the value. They know that you must find the present value. However, in the question, they don't want you to find the present value. If they want you to find the present value in your answer, they will give you the what? The period and also the discount rate. Maybe if you understood the standard very well, what you can do is you say that Josako should use an appropriate discount rate. Okay, that is implicit within the lease. Or just say, while finding the present value, Josako should use an appropriate discount rate. Are you getting me? And of course, that appropriate discount rate is always the incremental borrowing rate, if you've been following. That is the amount that the entity secures loans on the market. So it depends on the confidence you have in the standard that will determine how much you're going to write. Is that okay with everyone?
Yes.
Yes, Raymond.
I thought you use that like when you're finding the right of use for the asset, we use some discount factor to get that present value. So I'm thinking, what if we use that very discount factor to discount the termination penalties? What happens?
Raymond, we are not talking about Lugamba. Let me give you the question. You get it? Because let me give you the question and tell me which rate you're going to use. This was the question. Let me just copy it and give it to you. And then you tell me which rate you would use. In your paper, if they've not given you something, don't assume it. Just discuss and show them what would have been done. Are you getting me? So this is the question. This is the question. Raymond, do you remember this question? That we
Yeah, I
discussed?
kind of remember.
We discussed it last
Yeah.
week. Not even last week. This week, I think on Tuesday. Okay. So this is the question. There is no discount rate anywhere. And then at the end of it, they give you this statement. Are you getting it?
Yes.
Then they tell you discuss the accounting what? Have you seen?
Yes, I have.
What the examiner wanted was for you to say that as per IS 16, the lease liability should contain the termination what? Penalties. And these are carried at the present value of the termination penalty. Then you say that, therefore, Ramco should increase the lease liability by the present value of the termination penalty of 6 million. Do you get it?
Yes, thanks a lot.
Yes. So don't say that since I don't have the rate, what should I use? This question is on IS 36. It is on IS 37. You get me? It is on IFRS 5. But they have brought in like a small statement on IFRS 16. Is the team getting the depth of your paper?
Yes.
And if you think you're going to spot, my dear, it is wrong for you. You must cover all the standards so that if an examiner integrates a small part from one standard, you can be able to realize that, oh, this is IFRS 16. Oh, it talks about lease liability. Oh, it should be present value. And then you discuss those. And then, Joseph, when you asked which discount rate, because you are an accountant, you are expected to be technically conversant with the treatment of the transactions. So you're saying that Ramco should use an appropriate discount rate expressed or implicitly within the lease can earn you mark. Because you've known, yes, we need to put into consideration the discount rate that we must use to find the present value. And in most cases, we always use the present value at what we call the borrowing rate of the company. If you can't get an implicit discount rate for the lease, then you can use the borrowing rate of the company. Are we getting it?
Yes.
All right, so let me remove this. It wasn't my discussion. I wanted to show Raymond that not all questions will require you to calculate, but rather to discuss. Now, when it comes to the right of use asset, we said, of course, initially we do what? We use the cost, okay? Just like other assets, initially recognized at cost. Recognized at cost. Another question is, what are the costs that should be included in the initial recognition? Even this one is also initial what? Recognition. This is also initial because subsequently we are going to have the lease payments reducing the lease liability because you're going to be paying. So this one initially, since it is an asset, initially you subject it to initial cost, and this initial cost should include 1, anything that is within the lease liability. Whatever you're going to pay in the future should be included in the right of use asset. Are we getting it? The initial measurement of the lease liability. Because you're going to be paying money out, whatever you're paying out is going to be form part of the asset that you own within that that leased asset. Then 2, they tell us that we can use any payments, any lease payments made either at or before the commencement date. Before the commencement date. So anything that you paid during the point when you're exchanging the assets or before the lease period start should be part of the right of use asset. Then we should also have all the initial, all the direct costs attributed to the lease agreement. Any cost that is incurred in the process of making the lease agreement materialize should be included as right of use asset. Then, if you can remember very well, UIS 16, any dismantling costs, any dismantling or decommissioning costs. Any dismantling or decommissioning costs can also form part of the what? Can also form part of the lease. Now subsequently, that is after recognizing the lease in your books, you have the lease liability, you also have the right of use asset. I've told you that with the lease liability, subsequently, since you're going to be paying money out, okay, since you are going to be paying money out, okay, let me start from here. You obtained the present value, not so? Do you remember something like unwinding of interest? Do you remember it?
Yes.
So, this lease liability should be increased by unwinding of interest, what we call the finance costs. So each year that passes, you must pay what we call some interest. But for you to easily recall, it's like unwinding of what? Of interest. So you must increase your lease liability by, okay, let me put it here. Lease what? Lease liability increases by the interest paid, in bracket unwinding of interest. So it increases by that much, meaning that since this is talking about interest, it is a finance cost. And we are talking about a liability, so you credit what? So at each year end, you're going to have the lease liability increase, let me even call it lease liability, increase by the finance or by the interest that you pay for that liability, lease liability. But remember guys, while your liability is increasing by unwinding of interest, you are also making some payments. Is that true? Is that true? But the entity is making annual payments. So you're going to be reducing your lease liability, and then you lose cash. Is that okay with everyone? This is the subsequent treatment of the lease liability. Any question regarding this subsequent measurement, or I proceed?
A question.
Yes, please.
A question.
Please ask.
Hello?
Please ask.
Yes. For the initial recognition, the initial lease liability would because but from an entry perspective, initially do we debit the right of use asset and then create the lease liability at initial recognition?
That's why, yes, that's why we said we have the right of use asset and then the lease liability. And you're seeing that now you're seeing that the right of use asset has within it the lease what? The lease liability. You're getting it? So
Yes.
meaning that if we made any payment before, will this be loss of cash or gain of cash? I'm trying to show you this. You debited
Loss
your asset,
of cash.
right of use asset here, not so. You credited your lease liability, lease, because this value here should include the lease liability, not so. Let us assume this is 100 million. Maybe the lease liability is 80 million. You get it? But you paid out some money for the legal fees, not so. You paid out some money under this direct costs, right? You paid out some money, so you equate your cash or bank. Maybe you paid the lawyer 5 million. You getting it? Then you also paid out some down payment. You paid out down payment to the lessor. You paid out cash also, or you can save in bank. Maybe this one is 10 million. But you are going to incur money in the future to dismantle the asset. So you create a provision. Maybe the present value of the dismantling cost, this is 95, is 5 million. Have I answered your question now? Joseph, have I answered you?
Let me see. Yes.
These ones here are these statements that are made here. Let me put this one here. Let me put it down here. These statements here are these ones. That the right of use asset should include the lease liability, any payments made at or before commencement date. We said this one, maybe this one is for, we called this one legal fees. So you paid a lawyer. This one, you paid some down payment. So the sum of all those small payments make up the lease asset. Is that okay now? Well, this is provision for dismantling. Should I proceed, guys?
Yes.
Okay. So subsequently, we are saying the lease liability must increase by the interest charge, but reduce with the annual payments. Because you're going to be paying out money, so the lease liability will be reducing, but you incur some interest charge through unwinding of interest, so it increases. Is that okay? Then right of use asset. Subsequently, right of use asset. I know you covered these things in FR. Maybe someone missed FR. Okay, so this is right of use asset. Who can tell me? How do we treat the initial cost? How do we treat this now? This value. Since it is an asset, using your basic knowledge of assets, what should we do to it?
Depreciate.
Depreciate. That is if you are using the cost model, not so? Okay. What we know is the standard says we use cost model. Cost what? Model. Unless another measurement is selected. So use cost model. And this other measurement can be revaluation, not so? It can be revaluation or can be fair value. But if we are choosing cost model, then Mike has said we must depreciate the what? We must depreciate the asset. So charge accumulated depreciation from the carrying amount of the right of use asset. As simple as that. Do I need to discuss anything regarding I know there are other concepts that you can read or you can get through practice, but regarding lessee accounting, these are the basics that you must know. And so these are the basics that you must write about theoretically in the exam, because our paper is more of writing than number crunching. All right, now let us go to lessor accounting. Lessor accounting. Meanwhile, I assume that you guys know that we have two types of leases. Which one and which one?
Yeah, Mr. Ivan.
Yes, please.
Yeah, before you could proceed with this, I have a question. Yeah, say we are the right of use asset. We're using the cost model, but when it is impaired, now how do we measure it? What is one measurement? Is impaired.
I think it's
The right of
your network is not clear. I can't get you.
Okay, Ivan. Yeah, in case of use asset, yeah, once it is impaired in the lessee accounts, what adjustment? Yeah, what adjustment can we do this?
I can't get you, please. Is anyone getting him?
Yes, he's talking about if the thing is impaired, the right of use, that what do we do? When you're using cost model, what other like measurement do you use to measure?
Which other?
You remember you said that we use cost model. The standard said use cost model for the right of to measure the right of use, right? So he was asking, so in case of any impairment, what other method do we use to value? That's what I heard.
That's a good
It's
one.
not a method.
It is not what?
It's not a method. He's talking about entries. Okay, that's what.
Okay.
Unless it's not clear, but he said the entries for when there is an impairment.
Ivan,
Yes.
I don't know today what has happened to my network.
What are you saying, Michael?
Yeah, actually, yeah, I think this is Joseph, huh? Yeah, okay, if you got it from Joseph, that's my point. Yeah, the moment the asset is impaired, the right of use asset is impaired. What are some other subsequent measurements that the accounting standard implies that we can use?
All right. We all know that under cost model, we charge accumulated depreciation and what? And not so? Do you guys remember this? Do you guys remember that under cost model,
Yes.
we can charge this
We
also?
do.
So
Yes.
if the asset is under valuation model, okay, then apply IS 16. We all know the guidance of IS 16, not so? I am asking, do we know the guidance of IS 16 on valuation model?
Yes.
Yes.
If this is it, what I think you wanted to know, Michael. If the asset is under fair value model, fair value, then apply IS 40. Do we know the guidance of IS 40 for fair value model?
Yes.
All right. So this is an asset. So since it is an asset, it depends on where it falls. If this asset is under intangible asset, if it is an intangible asset, I'm presuming, apply IS 38. If it is PPE, use the cost model, then subsequently you apply IS 16 that gives guidance for PPE. If it is under investment property, use your fair value model, apply the guidance of IS 40. Mike, have I answered you now?
Yeah, it is okay, Ivan.
Okay, all right. Now, when it comes to lesser accounting, remember the standard now says for lessee accounting, we treat all the leases like financing leases. But for lessor accounting, the person who is offering their asset in the lease agreement, we must assess if the lease is finance lease or operating lease. Is the lease finance lease or operating lease? And the standard says a lease is finance lease if you are going to use the asset for the period that is beyond, or for the most useful life of the asset. Let me give an example. If we enter into a lease agreement with Michael and I'm leasing his vehicle, the useful life of his vehicle is 50 years, I'm assuming, and I'm using it for 45 years, then that lease agreement is a finance lease. Okay? And also, if you're going to use, okay, anyone? Yes, Joseph? Yes, Joseph?
Yes. Yes, Evan.
Yes, please.
Yeah. Yes. I thought. I don't know that is true. The operating leases, I thought they were in the standard. Is it IS 18? The lease IFRS 16. There are no more operating leases.
They're under what?
The operating lease, I thought it was under the old standard. Was it IS 18? Before they brought IFRS 16.
Please.
But for IFRS 16, there are no more
It
entering
was,
leases.
I think, talking about 17. Don't confuse my
I
screens.
17.
17. 17 was bifurcating lessee accounting into two, financing and operating. Okay, please don't take them there. Currently, under IFRS 16, lessee accounting is finance lease. Then for lessor accounting, it is two. Are you getting me?
Yes, yes.
Yes, Florence.
Even I was begging your pardon on that example of the years.
Okay, we are saying that, okay, if the lease term, okay, let me give an example. If the lease term is more, like, okay, let me try to get how I can phrase it. I give an example. If I enter into an agreement with Michael that I'm going to lease his vehicle, the vehicle is 50 years, but I'm going to use that vehicle for 45 years. It means that I'm going to be using the vehicle for most part of its useful life. Are you getting it? So at that point, that lease is a finance lease because I'm going to be using the asset for almost the rest of its useful life. And I should have control over that asset such that the risks and rewards are accruing to me. It takes us back to the definition of a lease, this one here. For the lessee accounting, no issue, finance lease. Right of use asset, lease liability. When it comes to lessor accounting, we must make sure that the lessee, okay, is going to use the asset for the most part of the useful life of that asset, and the lessee, that is the control, including risks and rewards, have moved from the lessor to the lessee. So if the lessor has lost, okay, if the lessor has lost control over the asset such that the risks and rewards are now moving to the lessee, that becomes a finance lease. A finance lease. A finance lease occurs when control of the asset, that is risks and rewards, are transferred from the lessor to the lessee. So if this occurs, then that is a finance lease. Otherwise, we have also talked about the period, the lease period. If the lessee is to use the asset for the substantial period of the asset's useful life, then that is also a finance lease. Have we got it?
Yes.
So if those ones now are not, if in the if in the discussion these ones are not fulfilled, by the way, there are also other conditions that bring about a finance lease under lessor accounting. If we talked about if that asset can only be used by the lessee, okay, then also that is a finance lease. If the asset can only be used by the lessee, then the asset, the lease, is finance lease. And other conditions. So you just have to keep knowing which other conditions can create a finance lease under the lessor accounting. But the standard says any other agreement that does not meet the conditions of a finance lease is an operating lease. Yes, please.
I have another question. So, for a case whereby the lessee leases the from the lessor for a period equal to its useful life, is that a finance lease?
It should be. Of course, if it is equal to, then it is more than the useful life, not so? As in, what we're looking at is, for you're saying, what if it is equal to the useful life, not so? Then that is, of course, a finance lease. Kubanga tugambye, so long as the substantial part of the life of the asset has passed over to the lessee, then that is a finance lease for the lessor.
So, is it more already like they have purchased it?
Is it what?
Is it more like they have purchased it because you're literally going to use it for all that period?
Yes, but now since we are talking about a lessor, you should say, have they sold it?
Yeah, have they sold it? Yeah.
Yes. Yes, they have lost control. And now that one is very good because it means they must derecognize the asset. Are you getting it, Patience?
Yeah. Okay. Thank you.
You're welcome. So, Joseph,
Yes, Evan.
I don't want you to take us to 17. I know it very well, okay? But don't confuse. I think you also know. Did you study it?
And I didn't, but I hear of it from practice.
Yeah, you see, 17 was bifurcating lessee accounting into two, just like lessor. Then IFRS 16 simplified it.
Okay. Maybe just the other thing, what are those book conditions under the lessor or both accounting? I think it see accounting where we can expense, where we can just expense off and come into the complex lease accounting. Those that are maybe below 1 year, maybe those value leases.
We are going to look at what we call operating leases also, where the guy, you just have to recognize an income, no need of, you just recognize any income, right?
An expense. Is it an expense? Expense.
That
right
one,
away.
you're talking about those of small value, and then you get, I know what you're talking about. We are going to look at it. Is that okay?
Yes, it's okay.
When we talk about small value and the
Short term.
Short term, perfect. That's why you just have to expense. True.
Yes.
But now at this point in time, we are discussing lessor accounting, okay? So, for the lessor accounting, we've said it's either finance lease or operating lease, right? If it is a finance lease, how do we measure it? Measurement, if it's a finance lease. So the standard says, okay, the standard says you just have to recognize a receivable. Remember, as patient said, it's like you have sold your asset. Okay? It's like you have sold your asset. And so you are going to be receiving, this guy was having lease payments, not so? This guy was having lease what? Lease payments. Where are they? Lease payments. Okay. I'm looking for that lease payment somewhere that we had. Here. The lessee is going to be paying you money. So you, the lessor, who has sold the asset, you are going to be okay, recognize a receivable. And of course, you must recognize the asset. Recognize a receivable. And this receivable is just exactly the opposite of what the lessee recorded. That is the fixed payments, the variable payments, residual value guarantee. You get it? Since you are the second party in the agreement here, this guy, he recognized a lease liability of what? Of this. And to whom are they going to? They are coming to the lessor. So you should recognize the receivable measured at the present value of the same what? Of the same items. Am I communicating? This is more like a double entry. So this guy is going to recognize a receivable. And how is it measured? Measured at the present value of what the lessee is going to be paying. So present value of the fixed payments, and these fixed payments are from who? From the lessee. And then variable payments, and then residual guarantees. Even these termination penalties are going to be yours, because in case the lessee terminates the contract, you are going to be receiving this money. So it's just a mirror reflection of what the lessee recognized under his liability. Is that okay with everyone?
So I have a question.
Yes, please.
So in that case, we put like, remember like that we did prior. Let's say we put rate of use, then we put the amount, then down we came crediting, let's say the like that. This case we also, let's say debit the, because then we do like what we did before, credit like liability, credit the termination, whatever penalty like that. That's what we do.
You are going to recognize the asset, not so?
Yes, I recognize the asset, but then I'm saying for the accounting entry, how do we account for it?
My dear,
We have done in the previous.
it is the mirror reflection of this. So what will it be?
So do.
It is the mirror reflection of that.
Do you? So that's where my question comes from. Like that, we have recognized that. Yeah. Remember, we said for this guy, for the lessor, we recognize the receivable.
Yes.
So now, where you put the rate of use, does it mean in the lessor accounting you're supposed to put receivable, or it still remains rate of use of the asset?
Now, Raymond, it will be the receivable, and then you equate to your asset. You get?
Yes.
You credit the asset because you're recognizing it, not so?
Yes.
and then you debit a receivable. And that receivable is the combination of these. Does it now make sense?
Oh yeah, now I get you.
You get?
Thank you. Yeah, I get you.
You are losing an asset and you gain a receivable. Let me hope guys are getting it, eh? All right. We are saying at this point, you must recognize the what? Yes, please. Recognize the asset.
Yes.
Yes, Joseph.
Would there be a need to test for that the impairment of the receivable under IFRS 9?
Under?
IFRS 9. Would there be a need to subsequently test for impairment of that receivable that you should be getting from the lessee?
Of course, a receivable is a receivable. Now for you, taking us to ECL. Not so?
Uh-huh. Yeah, the ECL, yes. Yes,
Expected,
yes, the ECL on that.
expected credit loss.
Mm.
That is a very important. That is a very, very important concept. Let me hope everyone knows it. You have to do that, Joseph, eh? Since it is a receivable. Of course, what if you think you're going to receive some money from someone they can't pay? They go bankrupt.
True.
Or what if they tell you that we shall not pay? So, guys, are we all okay with that concept he has brought up of ECL, IFRS 9? Raymond, have you heard about it?
Yes, I've heard about it, but then I'm not getting what exactly they say, because I know the only thing I know is the allowances, then the interest that we the table that you gave.
No, you see, this is application. Eh? He brought in, since we've talked about a receivable, you must test it for impairment under IFRS 9. Anyway, once we come to financial instruments, we shall see what he was trying to discuss. Eh? Let us now remain to Liz. Oh my God. Someone is. Yes, Michael. Michael?
Ivan,
Yes, please.
actually,
The
I
net,
have a question.
the network is not good.
My network is not good. Yeah, actually, it rained very heavily in Juba right here.
Hey, so
It's,
what is the question?
yeah, now, okay, when you are like at the point of signing the contract or an agreement to
Mm,
lease an asset to LSC, okay, over a period of time, as time goes, chances are that there might be some uncertainties. Yeah, that the lessee may not pay you.
mm.
As now, for you as a lessor, now do the contract that you might have signed with the lessee, okay, guarantees you it will your assets in case he goes back.
Michael,
Yes.
that question is what exactly Joseph was talking about. Testing for impairment for the receivable. And he talked about IFRS 9, expected credit losses. Do you remember that? So I didn't want to confuse the team, as some of them sounded like that was a new concept. But it is right. You must always check if the lessee can be able to pay that money under the agreement. Otherwise, you go and consult IFRS 9 SECL. Is that okay, Michael?
Yeah, it is.
Yes. And those who have not yet covered that concept, please do, because It is very important, and application is what can make you pass here. So subsequently, guys, for me, I feel this is very easy. Do you know why? Because what we did for this person is what we are going to do the opposite of the lessor. If the lessee was paying interest, what will the lessor do? Who can tell me?
Receive
The
finance
lesser
income.
reduces.
Finance income. Perfect. That is the opposite of finance charge. So the receivable increases by the finance income. This lessor pays income. Now I mean pays interest. The lessor receives the interest in form of finance income. Of course, this finance income goes to statement of profit or loss, which is very direct. Now, we've said that is okay. What is the opposite of the lessor here, of the lessee? This guy is going to be paying cash to reduce the lease liability, right? What is going to be reducing the receivable this side?
The payments he keeps on
Is it now payment
making.
or cash receipts?
The receipts until the payments from the lessee to the lessee.
To the
Yeah,
lessor.
to the
So
lessee.
the cash
Yeah.
receipts reduces the receivable. Are we getting it? Mwebagayi, mukitegeera?
Nyonyo.
Yes.
Michael. Mike, I think Michael doesn't understand Luganda, but
No, I do. I spent about 3 years in Uganda. So I can understand.
Obitegede?
Yes, like you getting it.
Perfect. Perfect. So, guys, is this okay?
Yes, it's okay.
And have I made it better?
Yes.
Yes.
I know someone's going to ask me for double entries. Please go and find them out. Let me not spoon feed you. Okay. Operating lease. We'll be talking about finance lease. Now operating lease. Measurement if it's an operating lease. If it's an operating lease. Remember, since we said a lease is an operating lease, if it does not meet the definition of a finance lease. A finance lease involves loss of control, meaning that for operating lease, there is no loss of control of the asset. So the lessor should not derecognize the asset. The asset remains in their control. The asset remains in their control, and so that agreement between the lessee and the lessor only creates an income. Are we getting it? Only creates an income. So this creates an income to the lessor. As such, he recognizes an income which is amortized. Should I use the word amortized?
I feel like the
Expense. When it's amortized, as if it is amortized over a period.
As such, it recognizes an income, okay, on the straight line basis over the term of the lease. Over the term of the. If you agree that I'm going to give you 10 millions for 5 years, when the asset useful life is 20 years, that is an operating lease, right? 5 years, 10 millions. So I'm going to be recognizing an income of 5 million divided by 10 years. That is the straight line basis. Are we getting it? The lessor
Yes.
recognizes an income on a straight line basis over the term of the lease, i.e., if an asset of useful life 10 years is leased to another party for 5 years, okay, with this amount of 10 million. Okay, let me not put half, this is tricky. Let me put 3 here. With this amount of 10 million, then let me make this to make my work easy. Then the finance income is distributed over the 10 over the 2 years. So each year you're going to recognize an income of 10 what? Of 10 million. Is that okay?
Yes.
And since, meanwhile, by the way, since this guy, where is it? Okay, this one is derecognized. Now, since here you are retaining the asset, you should continue to depreciate it as per the applicable accounting standard. Are we getting it? Since you still have control over the asset, you apply. All right. Now, can we go to sell and lease back? Someone wanted it. Sell and lease back. This is very easy. The first condition is you must identify if there is a sale as per IFRS 15. That is all. Are we getting it?
Yes.
Under sale and lease back, you must confirm if there is a sale. If there is a sale, as per IFRS 15, consideration is there is a contract, there is a movement of control, whatever, you know those 5 steps, right? Once you confirm that there is a sale, then go ahead and recognize the asset. If there is no sale, then continue to recognize your asset because you still have control over the asset. And when it comes to sale and lease back, the best example I can give you is, in fact, most people use it for financing purposes. You don't have money, you have a vehicle. You are using this vehicle to transport your goods, but you are facing financial constraints. What you do, you sell that vehicle to someone with money, they give you cash, then you lease it back. So the seller becomes the lessee, the buyer becomes the lessor. Is it making sense?
Ivan,
Yes, please.
this is a bit long. You, you rewind again. We are not getting it.
This is a what?
We are not getting it here. Can you pardon us?
I've said, okay, under this setting, the seller of the asset becomes the lessee, and the buyer becomes the lessor. That is if the conditions of IFRS 15 are met. That is if there is a sale. If there is a sale, the seller becomes the lessee because you sell the asset to get money. But since you still need to use the asset, you lease it back and you continue to use it. Are you getting me?
Yes, I think it's a good financing option, especially if you're not doing well as a company.
Yes, this
You
is a
sell, then you
financing
lease back.
strategy. Perfect. This is financing strategy by struggling entities with large asset base. You sell the asset, get the money, put it in your operations, then you lease back the asset so that you become a lessee and you recognize a right of use asset. You get it, eh? So the standard requires that the conditions of IFRS 15 are met. If they are not met, then there is no sale. Case 1. If the transfer is not a sale, i.e. conditions of IFRS 15 not met. So if it is not a sale, that means that control has not passed over to the buyer. You have not sold. In fact, the easiest way is you have obtained a loan. Are you getting me?
Yes.
I remember during my days, there was a question of, I think a company that had the forest, then it gave that forest to the bank. You get it? But the transaction was not meeting a sale. Meaning that the company took its forest to the bank as a security. Okay? We are saying, since no control has passed over to the buyer, then this is more of a loan with the asset acting as a security. So what does it mean? You, the seller, should retain the asset. They still have control. So you continue to depreciate your asset. Treat it as per the appropriate accounting standard. But then, just recognize a finance asset. I don't know if you're getting it. Okay, here we are
Yes,
saying
we are.
A finance liability.
a finance liability for the
Yes.
seller lessee, not so.
Yes.
And then for the
Yes.
lessor, this person who has given out the money recognizes a financial asset. That is the argument. Are you getting it? Since no control has passed over to the buyer, okay, then this is more of a loan with the asset acting as a security. As such, the lessee, okay, the seller stroke lessee has to recognize what? Has to recognize a financial liability, which is now IFRS 9, not so? Then the buyer stroke lessor only recognizes a financial asset because you gave out the loan, you gave out your money. So for you have an asset, the other party has a liability. And as I've told you, no loss of control. So this guy retains his asset, continues to apply the applicable standard. The buyer cannot recognize the asset, but rather a financial asset. And now we've said as per IFRS 9, even this one, as per IFRS, which is financial instruments, eh? Okay. Now what if the transfer is a sale? Case 2. The transfer is a sale, i.e. conditions of IFRS 15 met. When it comes to this one, when it comes to this now, this guy has lost control. The seller stroke lessee has lost control over the asset, so must recognize it. But they have gained a right of use asset, so now they are lessees. So this accounting treatment sets in. Have a lease liability, have a right of use asset. The lessor, the buyer or the lessor has bought an asset, so must recognize an asset, and then continues to apply the lessor accounting. Is that okay with everyone? Wanji?
Yes.
The seller,
That is true.
the lessee, has lost control over the asset. So, do you recognize it? But must apply the lessee accounting, i.e. right of use asset and lease liability, and then continue to measure them as per IFRS 16. Is that okay?
Yes.
Then the buyer stroke lessor has gained control over the asset, so recognize the asset and apply lessor accounting as discussed above, of course. Have you got me, guys? Meanwhile, it is
Yes.
Yes.
it is our pastoral upgrade time. What I'm going to do, I told you we are so much less of number crunching, but understanding the concepts. I know here you must know that at this point when you are recognizing the asset, okay, you are going to recognize a right of use asset, and therefore there is some calculation that we do of prorating to see what is the profit on the transfer. Please don't forget to do that part. It's very important. However, understanding the theory is more important.
But
Yes, please.
there's something that I've not understood on the last part. As you said, okay, if the sale, okay, if the transfer is a sale, okay. Now, who uses the asset in this?
The lessee.
We mean this is contrary to the first accounting standard,
It is what?
to the first part of the provision. This is contrary, according to me. Yeah, okay. According to the first calculation, the first accounting, where the controls the asset. Now, right here, the lessor is the one controlling the asset. Don't you see it is contradicting in any way?
Okay, let me add this one. The buyer, lessor, has gained control over the asset. So, recognize the asset and apply the lessee accounting when the control passes over to the seller stroke lessee after the right of use asset. Does it make sense now?
Yeah.
That's what we meant, eh?
So we mean other things. We mean other things. Huh? I am going to recognize this like an operating list.
It's not an operating lease. Of course, now that one goes back to the two conditions. Remember, the lessee for him is going to have the right of use asset and lease liability, not so. Now the lessor will have to determine if the contract is an operating lease or a finance lease. Are you getting it, Mike?
Yeah.
That's why I said apply lessor accounting. You go back and check. Is it finance lease or operating lease? Alright guys, so I think I'm done with this standard. Let me give you a question. You practice. Next time we meet, we shall solve that question, right? I've had a long day and tomorrow I'm working. I'm not like you guys who are probably going to be home for January Rumu Day. Okay. Joseph, are you working tomorrow? Joseph?
Yes, I'll just do a half day. I do half day.
You're lucky. I'm working full day, so 8 to 6. So it gets so tight on my end. Let me get you the question so that you can practice. I'm really tired. I'm exhausted. Michael, how do you handle?
You see, Ivan, I'm also a full-time, you see, employee. For me, I'm even worse.
You're even what?
I'm also worried.
What is worrying you?
Full-time employee in one of our local companies, as well as full-time ACCA student. You see, these two things don't sit together.
Yeah, I know it's really tricky.
It's tricky.
Okay, I think, guys, this is the question here. So you can try out. It's IFRS 16. Try it out. You can also go ahead and answer the ethics part, yeah? Because now you must be confident. Yes, you go through, read and see. Go through, read. This is what, is it Raymond who was talking about? Let me show you something here. Included within non-current assets of JOSA is a property in Ginger which has been leased to Opa Lounge under a 40-year lease. Okay? Under a 40-year. Florence, pay attention to this one, eh? The property was acquired for 20 million and was immediately leased to Opa. So, when these guys purchased and immediately leased, the director took it as an investment property. The asset was expected to have a useful life of what? This is what Patience was asking. Eh? If the lease term and the useful life are equal, is that a finance lease or operating lease? Patience, what is it?
It's a finance lease.
But you see, JOSA has classified the building as an investment property and adopted the fair value model. Is this true? Is this correct or wrong?
Wrong.
Now, you're going to read the scenario, understand it. I've given you the hints. Then you go ahead and answer the question. Is that okay, guys? All right. Let me share the question and the notes in the group before I take my rest. Have a good evening, guys. Please keep reading. Don't give up.
All right.
Thank you. Thank you, Albert.